Is Warren Buffett sounding the alarm? As the Oracle of Omaha shifts his portfolio into cash, investors worldwide are wondering, is a storm brewing in the stock market? In today's video, we'll deep dive into Buffett's moves and try to determine what those might mean for your own investment portfolio. Are we on the brink of a market correction, or is this just a strategic play by one of the most successful investors in the world? Today, I'll help you navigate these uncertain waters with confidence. So one of the most frequent questions we get relates to lump sum investing. So let me explain. Most young investors are funding their wealth creation journey through regular contributions, whether that's monthly or bi-monthly. This is called dollar cost averaging, and it works like a champ. Why? Because you're a winner either way. It's a natural hedge. If the market tanks, you're pissed off to see all those paper losses, but you're also happy that you're buying assets on the cheap. If the market soars, you're busy touting your Nostradamus-like acumen to everyone on social media, and we're all winners. Literally. The lump sum problem really starts to arise when you accumulate wealth at later stages of your life. Now, ideally, you always want to be invested, but certain life events often bring windfalls of cash. Someone dies and you need to pretend you're sad, but you're really not because you got a big inheritance. Your future ex-wife decides it's time to split the assets. You cash in on some equity at your place of employment. You sell one of your real estate holdings. These are just some examples of how people come across lump sums of cash. So let's say you have $200,000 to invest in the market, but you heard Warren Buffett pivoted hard into cash, and that's making you wonder, maybe there's a market crash coming. Well, hold your horses there, Maverick. We need to better understand what it is Buffett exactly did. We don't just parrot what other people say, we go and investigate ourselves. Indeed, Buffett's holding a record amount of cash, which implies that he thinks cash is going to outperform stocks, which of course implies that he thinks stonks are going down. So when Warren Buffett gets up every morning and logs into his Robinhood account and goes and checks to see what the apes are pumping in the FinTwat space, what he sees he doesn't like. So let's go take a look and see how much cash he's actually holding as of last quarter. So you can just pull up the latest 10Q and scroll down. I think it's 3 clicks and you get to this page which has assets. What we can do first is just combine cash with T-bills and call this cash since T-bills are liquid. So his cash has increased by $157 billion or 96% this year. Stocks, on the other hand, have decreased, as you can see, by $82 billion. So what we can do then is start to plot cash and stocks over time. And here you can see that in green there, that's cash. The percentage of cash relative to cash plus stocks is going up to over 50%. Now, that's not all the assets Buffett has. We're simply in this presentation going to focus on publicly traded stocks that he holds and cash. So you can see that ratio here. You can also see the total combined sum going up over time as the stocks Warren Buffett holds increase in value alongside the market. This is a very meaningful move to cash, and it may not be over yet. So what are some reasons Buffett might move to cash? Well, various speculations. I provided 5 here. Tax considerations. This is worth noting. We'll talk about this. He may be trying to lock in gains at the lower current tax rate. And Buffett said at the annual meeting in May that part of why he started selling Apple shares is he expects tax rates to go up in the future. Cash positions are often indicative of investors who think there are going to be opportunities in the future, and Buffett seems to think cash is quite attractive given the alternatives available in the equities market and the global economic situation. So there's some banter around the old macroeconomic headwinds. Portfolio rebalancing. This is a very compelling reason why he may have moved to cash. Apple's stake had become almost half of that entire portfolio. It was over half, actually. That's a very outsized percentage. That's a lot of risk that's being taken there. Valuation concerns. He may have viewed Apple's current valuation as less attractive to when he first invested. Indeed, that would be the case. and preparation for succession. So at 94 years old, Buffett may simply be ensuring that his new protege has a clean slate. So only one of these reasons is really cause for concern if you think about it, and it's the second one, that he's building cash because he thinks the market is going to go down, and that's what a lot of retail investors are raising to us. So I wanted to talk about his cutting of Apple, which was his biggest and continues to be his biggest position, but is perhaps the most significant thing he's done in a while. We want to look at how much was sold. What did he say about it? Is it overvalued? So I think the best place to start there is to go to the horse's mouth. You can go to Edgar, this is the SEC database, and pull up what's called 13F forms. And these are filed. You need to click that filing button, all right? And after you click the filing button, you can go ahead and pull up the HTML if you like, or XML if you're proficient in that respect. But the HTML works, and you'll get a page that looks like this. And then what you need to do is you need to select all the rows there for Apple, and then just paste them into an Excel spreadsheet and click Sum. That will give you the total number of shares that Warren Buffett is holding in any given company at any given time. And we pulled this up. This is from CNBC. It's as of the end of June last year, and it shows the top 10 holdings. Couple things to note here. So one of the reasons I'm pulling this up is so that you can see how this changed last quarter. So the most recent changes, and they're quite relevant. But a couple things here. First of all, his top 10 holdings represent nearly 90% of the total publicly traded stocks in his portfolio. So he's quite heavily overweighted. And there's a couple round numbers here of interest. Apple at 400 million shares and Coca-Cola at 400 million. Now, those numbers really don't mean anything except to say they're round, and CNBC had speculated that perhaps when he brought Apple down to that round number of 400,000, that he was going to leave that alongside Coca-Cola for some particular reason. Well, that didn't actually happen. So last quarter, he sold another 100 million shares of Apple, meaning he now holds 300 million. Well, I guess we don't know as of right now what he's holding, but as of last quarter, so that would have been in the end of September, he's holding 300 million shares of Apple. It's still his largest position by far. Apple at $71 billion in first place, Bank of America in second place at $49 billion, and in third place, Amex at $46 billion. So Apple's sitting at around 26% of his equities portfolio. But as I said before, it was once such a big position that was over half of his equity portfolio. Now, Buffett's a legend. It's certainly not advised that retail investors should ever do that. It's an extremely risky thing to do. Now, some analysts interestingly point to Munger's death. So that happened in November of 2023, and Buffett started selling Apple shortly after that. And they say, well, he's never been as comfortable with technology businesses as Munger was, and we'll touch on that. But others say he's rightfully taking profits and reducing risk. Both these points may be compelling, to be honest. And when we look at this chart by Guru Focus, it's very interesting. It shows the accumulation of Apple over time by Buffett. You can see that Buffett sold before, right there, in the 2020s. It looks like he trimmed his position. And in an interview, Buffett said this. He said, Charlie, in his usual low-key way, let me know that he thought it was a mistake. Didn't you, Charlie? And Charlie responded, yes. That's very interesting, because then when Munger died, Buffett put his foot on the gas pedal and started selling Apple shares dramatically, so that he has only left 30% of the position he had when Munger was around. Now, Buffett certainly may have decided it was time to take profits, and here we can see why. So he made 14 purchases of Apple at an average price of $39.62 for a total of over 1 billion shares, just over 1 billion, says Guru Focus. I've plotted that on the right so you can see that dramatic drop-off in share sales there. He sold 615 million shares this year so far at an average 52-week range of $201. We can do the basic math and see that he raised about $124 billion in cash doing so. Since he purchased Apple, it's up around 723% versus a NASDAQ increase of 268%, so he did fairly well for himself. He beat the benchmark. He's covered his cost basis 3 times over and still holds 30% of that original position. So what does Buffett actually have to say about Apple? Well, there's the shareholders letter, which I wanted to make a few points, and these aren't related to Apple. We'll talk about that in a second, but he said some great things here. He said, there remain only a handful of companies in this country, and he said before he's going to be focused on the U.S., that are capable of truly moving the needle at Berkshire. And he says they've been endlessly picked over by us and others. He's talking about spending all that cash on the balance sheet. He says Berkshire's ability to immediately respond to market seizures with both huge sums and certainty of performance may offer us an occasional large-scale opportunity. Here he's hinting at what retail investors see as a possible weight in pounds for a market correction. He says some very wise words next. He says, and these are just tidbits taken from that call, he says, though the stock market is massively larger than it was in our earlier years, today's active participants are neither more emotionally stable nor better taught than when I was in school. And he is absolutely right. We blame the proliferation of social media on that, and also the availability of things like 24-hour trading and crypto and NFTs and ICOs and all this bullshit that's being thrown at retail investors and pushed down their throats in a bull market where everybody's a winner, and it's creating a lot of bad habits. He says, for whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. And he says, the casino now resides in many homes and daily tempts the occupants. And he's absolutely right. He says at such times, whatever foolishness can be marketed will be vigorously marketed, not by everyone, but always by someone. So then he proceeds to gloss over Apple, and he fawns over Coca-Cola and Amex. And he said he hasn't bought or sold those two stocks for several decades now. And in the 2024 meeting, and there's a transcript out there, it's well worth a read. I think you should read all his shareholder letters. They're not only wise, but they contain some funny bits. The man truly has a great sense of humor. He says in the Berkshire meeting regarding Apple, so this analyst poses the question, have you or your investment manager's view of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016? And Buffett says, no, I would. And then he goes off on this massive tangent. But we cherry-picked some bits from that tangent that are worth noting here. He says, we own Coca-Cola, which is a wonderful business, and we own Apple, which is an even better business. So that implies that, he said that before, that his view on Apple hasn't changed. He says, unless something really extraordinary happens, we will own Apple and Amex and Coca-Cola when Greg takes over this place. So he's talking about the person will take over when Buffett at 94 years old passes on. And then he talks about taxes. He says we're paying a 21% federal rate on the gains we're taking in Apple. And that rate was 35% not too long ago, and it's been 52% in the past when he's been operating. And he says, I would say with the present fiscal policies, I think that something has to give, and I think higher taxes are quite likely. So there you go. That's the his comments on taxes. And he says in his last point here, I don't think you'll actually mind the fact that we sold a little Apple this year. And of course, we need to wait and see if that was the case. But I liked this other statement that he made in the call. It says, we'd love to spend it. He's referring to all that cash on his books that we looked at. But we won't spend it unless we think we're doing something that has very little risk and can make us a lot of money. So we absolutely love Buffett's risk-averse approach to investing. And the question about whether or not Warren Buffett is preparing for some cataclysmic event in the market, I think there's two compelling arguments that can be made here. One is that the bull is only beginning. AI is going to usher in more value creation than you can imagine. All companies will benefit from that across all industries because they're going to become more productive. But just beware of Gartner's hype cycle. We put out pieces before on this. This time is not different. And those who think otherwise, well, those are the four most dangerous words in investing. This time it's different. So you need to be very cautious. You can always torture the data to make it say what you want in either direction, I think, for either argument. But many signs indeed point to an overvalued market where fundamentals need to catch up. So I think it was a Goldman Sachs strategist that once wisely said, you can have hype, that's perfectly fine, but fundamentals need to catch up to that hype or the valuations will revert to the mean. So it remains to be seen what will happen. But if you look at this chart here from Bank of America is quite good. So it shows valuation metrics. Now these were taken from July of 2023, but I think they're still probably quite relevant, and you see this numerous valuation metrics that where the market is currently measured as being quite rich. So that's worth noting. Now, when we talk about getting into the market, I think it's important to know a lot of people approach this as a decision where it's buy stonks or stay in cash. That's literally the decision they think they have to make. Well, first of all, you should consider investing in multi-asset class allocations. So then you're going to reduce your reliance on equities and you'll still be invested in the market. What do I mean by that? Well, different asset classes. You have real estate or REITs, you have bonds, you have alternative assets. These are all things that you can invest in that will provide a diversification effect so that if the market does fall, you're going to be insulated to a certain extent. Now, we have coming pieces on fixed income or bonds and alternative assets, some really great pieces. Make sure you're subscribed for those. Those will be coming out fairly soon. So what you could do as a hybrid approach is what we might call accelerated dollar cost averaging. So going back to that $200,000 example, what you could consider doing is this. You could invest $16,667 every 2 weeks for 6 months. So you can really just have that shorter time frame for dollar cost averaging, but it's still a meaningful amount of time. Or you could extend that to 12 months and invest $8,333 every 2 weeks. But you don't have to make binary decisions either. You can do a hybrid and say, well, I'm going to invest $8,333 every 2 weeks for the next 6 months. During that time also, I'm going to have $100,000 in cash that's generating 4% a year because interest rates are quite nice right now. So you see, then you can decide after 4 months, maybe you start dollar cost averaging in that $100,000, or maybe you just let that sit on cash and try to time the markets. Just remember, you're never going to buy at the bottom and sell at the top. Now, I know there's plenty of man bites dog stories that you find in the FinTwat space, fair enough, but the vast majority of time, you're not going to be successfully timing the market. Even professionals who spend their entire lives doing this stuff can't. So just some thoughts here. There's a compelling case to be made here for Buffett simply trimming that apple overweight and feeling more comfortable about doing that since Munger has passed on. Now, Buffett doesn't rush into new assets. He's calculated. He wouldn't immediately put a windfall to work. He wants bargains. So in an overvalued market, I think it's understandable that he's not able to find very many, as he said. Market's overvalued by many objective measures. And I think what's also useful to note is the human side of this. Buffett's 94 years old. He really doesn't care what other people think, but perhaps he cared a lot about what his closest business partner thought, someone who was his friend for 65 years. When your friend of 65 years dies, that can lead to you making some dramatic decisions, life decisions perhaps. This could be impacting his decisions. Whether that's good or bad, we just don't know. But based on his track record, is probably making wise decisions as always. And we just don't ape active managers. And I said never. I say very rarely. I'm sure somebody will go dig up some case where we tried to time the market. And we very rarely try to time the market. Over 20% of our own disruptive tech portfolio is currently in cash, and we're waiting for better valuations on certain assets we have on our wish list or that we'd like to add to. So similar to Buffett's approach, we're very risk averse and we don't want to overpay in a overheated market. That's our tech portfolio. Of course, our dividend growth portfolio is always invested. We would just add to it using dollar cost averaging if we had more assets that we could add, and we'd focus on underweight assets in that portfolio. So for example, we recently trimmed, I think Aflac was a stock that's just been on a tear and it was overweight in that portfolio. We trimmed it and we invested in some of the lower weighted assets in the portfolio. I think we'd take that same approach if we had a lump sum. We'd say, okay, what are the 30% of the assets that have the lowest weighting in this portfolio, 10 stocks, and plow the money into those and sort of try to rebalance it to equal levels across the portfolio. But for people with no wealth in a lump sum, this is an interesting place to be in because it means that you have a whole bunch of money that you don't really know how to manage because you haven't had money before. Easy come, easy go. Very dangerous spot to be in. I put up another video here that you might want to check out. This proposes a 3-fund portfolio that's perhaps one of the safest ways that you can invest your money in a market that's overheated, and one of certainly the most prudent things to do, and I would say the easiest pathway to wealth. Thank you so much for taking the time to watch this video today.